conventional and unconventional instruments may help to avoid a collapse of the banking sector. But it can also come at the expense of reduced incentives for balance sheet repair by individual banks. It can promote the evergreening of non-performing loans and even regulatory forbearance. In this context, unconventional policy instruments are more intrusive than conventional monetary policy, and they can therefore create deeper distortions that aggravate the risk of misallocation of resources and financial instability. It's often argued that macro-prudential and not monetary policy should be geared toward financial stability risks. But here I tend to agree with Charlie Bean that there are important qualifications to this somewhat Panglossian view of the ability to maintain both price stability and financial stability by assigning monetary policy to the former and macro-prudential policy to the latter. Quote. This implies that an effective macro-prudential policy is a necessary, but it's not a sufficient condition for monetary policy to be effective also in the medium to long run. Central banks must therefore be conscious of unintended consequences of a monetary strategy that keeps policy rates low for a long time. Translating this to the current context, my main takeaway is that as long as inflation remains subdued, central banks are likely to maintain an ample degree of monetary accommodation, but the longer this accommodation is maintained, the more pressure will actually mount on financial regulators and supervisors to be able to preserve financial stability. So what would this mean in practice, and how does it relate to the international regulatory agenda? My key point here is that in an environment in which monetary policy is likely to remain accommodative for some time, it is important that the agenda for financial reforms is pushed ahead along several dimensions. Let me elaborate here also by referring to the same three elements: necessity, effectiveness, and possible unintended consequences. The first question is whether the regulatory reforms that have been adopted are still necessary. Well, I have a very short answer here, and that is absolutely. And I believe we need to even strengthen our regulatory toolkit further. As I mentioned before, the global financial crisis could develop in an environment with high growth and increasing risk appetite, with low interest rates and abundant liquidity on the one hand, and on the other hand, the emergence of new risks due to technological developments and innovation that were not adequately captured by microprudential and macroprudential regulation. The regulatory reforms taken in response to the crisis were thus needed to restore the balance in a previously under-regulated sector. As of today, vulnerabilities in bank intermediation are much smaller and bank resilience is much stronger. However, some of the drivers of the crisis are still present. The total debt of households, firms and governments as a percentage of GDP is now higher than it was 10 years ago. Short and long-term interest rates are still relatively low. And financial institutions and markets remain strongly interconnected. In this context, we should be wary of recent indications of diminishing momentum for regulation. And there are even industry calls for rolling back some of the agreed reforms, to which I clearly would not subscribe. On top of that, I would like to highlight the need to further develop the macroprudential toolkit. The current macroprudential tools are incomplete, and by design they are limited in scope and impact. Almost all jurisdictions have by now established a macroprudential authority, but there is still some difficulty to identify and/or some reluctance to actively develop macroprudential policies and instruments to address risks to the financial system as a whole. The second question is whether the regulatory reforms carried out thus far were effective. Although the early signs of much stronger resilience in the core financial system are encouraging, it's still relatively early days to judge whether this has been enough. Too big to fail incentives have surely been reduced, but few would argue that they have actually been eliminated. The new rules in response to the crisis were also designed in a short time frame, and many reforms progressed in parallel. It is therefore a natural process that after the initial implementation of such a comprehensive set of reforms, policymakers now shift their focus to the phase of policy evaluation. International standard-setting bodies, like the FSB, have to continuously assess the design and the implementation of reforms to see whether regulation meets the objectives while minimizing distortions. And this is actually what we are doing today. It goes without saying, of course, that such analysis should be evidence rather than sentiment-based and focused on better rather than less regulation. The global financial crisis has also shown that international cooperation is key in developing effective regulatory policies. The global financial sector is closely integrated, and national or regional developments create external effects that directly and indirectly affect financial stability in other jurisdictions. Developing a common approach creates a level playing field between jurisdictions, which avoids regulatory arbitrage. The post-crisis reform agenda, but also the creation of a single supervisory mechanism in Europe, are important examples of such successful international cooperation after the crisis. The third question then relates to the unintended consequences of regulatory reforms. And a main concern here is the potential of shifting risks outside the regulated sector as new rules come in. As Charles Goodhart forcefully argued, prudential policies face a so-called boundary problem. Effective regulation can penalize financial intermediaries within the regulated sector compared to those just outside, leading to substitution flows toward the unregulated. For example, when it comes to what we now call non-bank financial intermediation, formerly known as shadow banking, the growth of total assets in recent years has been higher than in traditional banking. It is true that since the crisis, efforts by the G20 and the FSB have resulted in better insight into the non-bank intermediation. Yet, there are still important questions about the potential systemic risks originating from the unregulated sector and how these risks could interact with those emanating from the regulated sectors. So let me conclude. The global financial crisis was a sobering experience that presented an existential threat to financial stability. The potential disruptive effects to the financial sector and the economy at large called for exceptional measures. In those turbulent times, the monetary, regulatory, and supervisory response essentially followed three guideposts. First, authorities did what was needed. Secondly, they implemented policies that were effective. And thirdly, they tried to mitigate unintended consequences. We've come a long way. Financial stability has been restored, and the financial system is more robust than 10 years ago. However, the next 10 years will undoubtedly present new challenges. History teaches that new vulnerabilities will emerge, and the next financial crisis will eventually occur. We cannot assume that financial regulation will always be fully able to prevent the next crisis, because regulatory coverage is never perfect, it's never complete. And new risks can also emerge from other segments of the economy or its financial sector. Technological innovation will continue to change the business model of banks and how they operate within the financial sector. New businesses will emerge along the chain of value creation. These fundamental changes can lead to disruptive innovation and to new operational risks, like cyber, for instance. Such risks are outside sort of the natural domain of regulatory authorities, but they will become increasingly important to financial stability. Financial supervisors should therefore continue to expand their knowledge and enhance their risk monitoring activities in these areas. And this underlies why we all have to remain vigilant and continue to adhere to our strategy of pursuing a sound financial system. It would support and enhance current monetary policies, and it would contribute to containing the unintended consequences. In addition, a well-regulated financial sector would also provide us with a much better starting point than prior to the global financial crisis. Well, little that I said is entirely new. And yet I feel that those words should be heard again. Let me illustrate that with a 2001 quote from the late Andrew Crockett, which was one of the founding fathers of the Financial Stability Board. Perhaps, instead of everything that I said today, these words alone would have sufficed. I thank you for your attention.